Most people think they understand the S&P 500. They've heard it's safe, diversified, a solid long-term investment, and all the usual phrases you hear in personal finance videos. But what if I told you there's a quiet secret hiding inside the S&P 500 that most investors never bother to look at? A secret that, once you understand it, completely changes the way you see the index and might even change how you invest for the rest of your life. And no, this isn't about some hidden stock, some trick, or a new way to buy index funds. This is something sitting right in front of millions of investors, and almost none of them realize it. Yet it affects every dollar they put in. If you stay with me until the end of this video, you'll understand this secret clearly, and you'll be able to look at the S&P 500 differently from 99% of investors. And once you do, future investment decisions will feel less confusing, less emotional, and a whole lot more strategic.
Hi there. Before we dive in, please take a moment to read the full disclaimer on the screen.
Let's get into it. Here's the truth most people miss. The S&P 500 is not an even mix of companies. It's not 500 companies contributing equally to your returns. It's not even close. The S&P 500 is a weighted index, which means the bigger a company is, the more influence it has on your investment. And this is where the secret begins. Because most people think the S&P 500 is diversified. They'll proudly say, "I'm investing in the whole U.S. stock market through the S&P 500. But are they really? Or are they accidentally investing heavily in just a handful of giant companies without realizing it? Think about this for a moment. If you had to guess, how many companies in the S&P 500 do you think truly drive most of the growth? 10? 20? 50? Before I reveal the real number, drop your guess in the comments. I'd love to see what you think. Now here's the real answer. Most of the S&P 500's performance comes from a tiny cluster of companies, often fewer than 10, but consistently dominated by the largest companies in tech. The index is technically 500 companies, but the top few can control around a quarter or even more of the entire S&P 500's movement. That's like going to a buffet with 500 dishes, but only being allowed to eat the top 5 while the rest barely matter. This is the secret most investors miss. The S&P 500 is not a diversified index. It is a concentrated index disguised as a diversified one. And the concentration keeps getting stronger every year. Some people might wonder, but isn't that bad? Isn't concentration risky? That's a great question. And here's where things get even more interesting. Concentration isn't automatically bad. In fact, it has helped the S&P 500 deliver strong returns. The biggest companies became big for a reason. They dominate innovation, technology, consumer behavior, and global trends. But the danger is when investors think they're getting one thing, a broad slice of the American economy, when in reality they're heavily betting on a very specific group of mega companies. Let me ask you something. If the S&P 500 is mostly driven by a handful of giants, how comfortable are you with that? Does it make you feel safer because those companies are strong, or does it make you a little uneasy knowing your index fund is more concentrated than you thought? Share your thoughts in the comments, because it's something investors rarely talk about. Here's another part of the secret. The S&P 500 isn't just concentrated, it's self-reinforcing. Once a company becomes large, it gets a bigger weight in the index. That bigger weight pulls in more investment from index funds, and that investment helps it grow even more. It's like a popularity contest where the winners keep getting more attention simply because they're already winning. Now, does that mean the S&P 500 is flawed? Not necessarily. It just means you should understand what you're really buying. You're not buying the whole U.S. economy equally. You're buying the biggest players, and the rest are in the background. Another part most investors never think about. If the biggest stocks have more power, then the index's performance becomes more sensitive to what happens to those few companies. If one of them drops, it affects the whole S&P 500 much more than if a smaller company falls. This is why some years you'll hear people say, the market is up, but in reality, most companies are down. The reason? The giants carried everything on their backs. Other years, the opposite happens. The giants fall, and suddenly the entire market looks weak, even though many smaller companies might be doing fine. Now let's go deeper. Another hidden truth is that the S&P 500 is not only dominated by the biggest companies, it's dominated by a single sector: technology. Many people say, "I'm diversified across industries," but the reality is that tech and tech-adjacent companies hold a massive influence. Even companies that are technically categorized differently, like communication services or consumer discretionary, still draw most of their power from technology-driven business models. So when you think you're diversified, you're often making one giant bet, a bet on tech innovation continuing to lead the market. Now here's a question worth thinking about. Do you believe technology will still dominate the future as it does today? If yes, then the S&P 500's concentration might actually make you feel more confident. But if you believe the future might shift to other industries like energy, healthcare, biotech, or something new entirely, then that concentration might feel like a hidden risk. Drop your thoughts in the comments. I'd love to hear how you see the future playing out. But let's zoom out. Why do so many people never see this concentration? Why do millions of investors think they're getting something broad and balanced? It's because the name S&P 500 sounds big. It sounds diverse. It sounds like it covers everything. And while it does include 500 companies, the power inside the index is far from evenly distributed. Another secret most people miss is how the S&P 500 actually selects what qualifies as a top company. It's not simply the largest 500 companies by size. There's a committee that decides who gets in, who gets removed, and when changes happen. This creates another quiet effect. Companies that get added sometimes jump in price because being included in the S&P 500 means index funds must buy them. Companies that get removed sometimes drop. So the index isn't just reflecting the market, it's shaping the market. Here's something important to keep in mind. The S&P 500 is not a neutral snapshot of the U.S. economy. It is a curated list with rules, weighting, and decision-making behind it. Knowing this helps you understand why the index behaves the way it does, why it rises, why it falls, and why it sometimes feels disconnected from the world around us. Now let me ask you something that might surprise you. If you had an option between investing in 500 companies equally versus investing in just the biggest ones that dominate today's technology landscape, which would you choose? Would you prefer broad balance or strong concentration? Share your answer in the comments. I'm genuinely curious which side you're on. Before we go deeper, if you're enjoying the video so far, make sure you hit that like button, subscribe, and share this video with someone who invests in the S&P 500 but might not understand what's really inside it. You'd be surprised how many people buy index funds without ever questioning what they actually own. Now let's talk about something that surprises almost everyone. The S&P 500 isn't as old as people think, and its structure has changed dramatically over time. Decades ago, the index was more balanced across industries. There wasn't a tech dominance because the tech industry wasn't the powerhouse it is today. This means that the S&P 500 evolves based on the era it's in. Today, it's tech-heavy. In the future, it could shift again, maybe toward AI, renewable energy, robotics, biotech, or something we've never even imagined. So the secret isn't just that the index is concentrated, it's that the concentration reflects the present era, not necessarily the future. That's why understanding the index at a deeper level matters, because investing is about the future, not the past. Here's something else few investors consider. The S&P 500 has a hidden momentum effect. Since it's weighted by market value, companies that perform well get bigger weight. That bigger weight pushes the index up more, which attracts more investment, which pushes those companies even higher. It's like a snowball that rolls downhill and gets bigger simply because it's already big. This creates strength in bull markets, but can magnify weakness in downturns. Let me ask you this. Do you think the momentum effect helps the index more than it hurts it? Or do you think it adds unnecessary risk? Let me know in the comments. Another hidden detail is that the S&P 500 doesn't include everything. Many massive companies aren't part of it because they aren't US-based. Many small and mid-sized companies that could be rising stars aren't in it either. So when people say the S&P 500 reflects the whole market, that's not true. It reflects the largest US companies, which means it excludes thousands of companies that might be growing even faster in other areas of the economy. And here's one more question to think about. Do you prefer investing in the giants that already dominate, or the smaller companies that could become the next giants? Drop your thoughts in the comments. I'm really curious how you think about opportunity and potential. Now, after learning all of this, should you avoid the S&P 500? Not necessarily. It's still one of the most powerful tools for building long-term wealth. But the difference is understanding what you're buying. It's not a basket of 500 equal companies. It's a concentrated group of the largest companies in the world, with hundreds of smaller players in the background. Knowledge gives you an advantage. When you understand the structure, you can make smarter choices. You may choose to pair the S&P 500 with other investments, like total market funds, equal weight funds, international funds, or even specific sectors to balance your exposure. Or you might decide that the concentration is a feature, not a flaw, and lean into it because you believe in the strength of major US companies and their long-term innovation. The goal isn't to follow some rule. The goal is to understand the game so you can choose how you want to play it. Before we wrap up, here's one last thought-provoking question for you. Now that you know the S&P 500's hidden secret, does it change how you see your own investment strategy? Would you adjust anything? Or does this new perspective simply give you more confidence in what you're already doing? Share your answer below. I'd love to hear how this video changes your thinking. And if you found this video valuable, make sure you like, subscribe, and share it with someone who needs to understand this hidden truth about the S&P 500. The more investors understand what they're actually buying, the better decisions everyone can make. Thanks for watching, and I'll see you in the next one.